Ever wondered how you can make your investment portfolio more stable and predictable? Welcome to our channel. Today, we're diving into the world of bonds, one of the most reliable ways to invest for steady income and long-term security. Let's explore the different types of bonds, their key features, and how to navigate the risks and opportunities they present. Stick around and discover how bonds can be a game changer in your investment journey. Number 1. Types of bonds. Bonds are debt securities issued by various entities to raise capital, with the issuer agreeing to repay the face value at maturity and make periodic interest payments. Understanding the different types of bonds is crucial for making informed investment decisions. Government bonds, such as U.S. Treasury bonds and EU government bonds, are typically viewed as low-risk investments. U.S. Treasury bonds, including Treasury bills T-bills, Treasury notes T-notes, and Treasury bonds T-bonds, are among the safest due to the government's taxing and money-printing capabilities. Similarly, EU government bonds, like German Bunds and French OATs, are generally safe but vary with each country's economic stability. Municipal bonds are issued by state or local governments to fund public projects. They include general obligation bonds, backed by the issuer's credit and taxing power, and revenue bonds, secured by specific revenue sources such as tolls or utility payments. General obligation bonds are considered low risk, whereas revenue bonds carry higher risk but can offer higher returns. Corporate bonds are issued by companies for expansion or operations and vary in risk and return based on the company's creditworthiness. They are categorized into investment-grade bonds, issued by financially stable companies with strong credit ratings offering lower yields but reduced risk, and high-yield bonds, issued by companies with lower credit ratings offering higher yields to compensate for increased risk. Green bonds, a more recent development, are issued to fund environmentally positive projects and appeal to investors interested in sustainable and socially responsible investing. Understanding these categories helps investors align their choices with their risk tolerance, investment goals, and ethical preferences. Number 2. Bond characteristics. Understanding bond characteristics is crucial for evaluating their fit with your investment goals. The coupon rate is the interest paid by the bond, expressed as a percentage of its face value. It can be fixed, where the rate remains constant throughout the bond's life, offering predictable income, or floating, where the rate varies based on an index like LIBOR, adjusting periodically with market conditions. The maturity date is when the bond's principal is repaid to the bondholder, with bonds falling into different maturity categories. Short-term bonds typically have maturities of less than 5 years, providing lower yields but reduced sensitivity to interest rate changes. Medium-term bonds have maturities between 5 and 10 years, striking a balance between risk and return, while long-term bonds exceed 10 years in maturity, usually offering higher yields but with increased susceptibility to interest rate fluctuations. Additionally, the face value, par value, is the amount returned to the bondholder at maturity, commonly set at $1,000 but varying among bonds. These characteristics, coupon rate, maturity, and face value, help investors determine the bond's income potential, risk profile, and how it aligns with their financial objectives and market conditions. Number 3. Risk factors. Investing in bonds involves several risks that can impact their performance and value. Interest rate. Risk is a primary concern as bond prices typically decline when interest rates rise and increase when rates fall. This occurs because existing bonds with lower coupon rates become less attractive compared to newly issued bonds offering higher rates. This risk is particularly pronounced for long-term bonds, which are more sensitive to interest rate fluctuations. Credit risk refers to the possibility that the bond issuer may default on its payments. Credit rating agencies such as Moody's, Standard & Poor's, and Fitch evaluate the creditworthiness of issuers and provide ratings that reflect the likelihood of default. Investment-grade bonds, with higher credit ratings, carry lower default risk, whereas high-yield bonds, with lower ratings, have higher associated risk. Inflation risk involves the erosion of the purchasing power of the bond's interest payments due to rising inflation. When inflation rates increase significantly, the real value of fixed interest payments diminishes, leading to reduced effective returns. Lastly, liquidity risk pertains to the difficulty of selling bonds quickly without impacting their price, which can be a concern if you need to access your funds before the bond matures. This risk is especially relevant for bonds issued by smaller entities or those in less liquid markets. Understanding these risks, interest rate, credit, inflation, and liquidity, helps investors make more informed decisions and manage potential impacts on their investment portfolios. Number 4. Investment strategies. To effectively manage risk and enhance returns in bond investments, investors utilize several key strategies. Laddering involves buying bonds with staggered maturities, such as 1-year, 3-year, and 5-year bonds, which helps mitigate interest rate risk by ensuring that not all bonds are affected by rate changes at the same time. This approach also offers regular opportunities to reinvest at potentially higher rates as bonds mature. Diversification is another crucial strategy, spreading investments across various types of bonds, government, municipal, and corporate, and different maturities. This technique reduces the risk associated with any single bond or issuer, improving overall portfolio stability and performance. Bond funds and ETFs provide a practical alternative, offering broad exposure to a diversified portfolio of bonds through mutual funds or exchange-traded funds, ETFs. These funds can focus on specific bond types or offer extensive market coverage, allowing investors to gain diversified exposure without selecting individual bonds. Lastly, active versus passive management refers to the two main approaches for managing bond funds. Active management involves fund managers making strategic decisions to outperform the market, which can lead to higher returns, but often comes with higher fees. Conversely, passive management aims to replicate the performance of a bond index, generally resulting in lower fees but potentially lower returns. By understanding and implementing these strategies, laddering, diversification, bond funds, and management styles, investors can better navigate the complexities of the bond market and optimize their investment results. Number 5. Tax considerations. Tax implications can significantly influence the net return on bond investments. Taxable bonds, which include most corporate bonds and some government bonds, have interest income subject to federal and potentially state and local taxes. As a result, higher income tax rates can diminish the effective return on these investments. In contrast, tax-exempt bonds, such as municipal bonds, often offer interest income that is exempt from federal income taxes and sometimes from state and local taxes if you reside in the issuing state. This tax advantage makes them especially appealing to investors in higher tax brackets. To compare tax-exempt bonds with taxable bonds, investors can use the taxable equivalent yield. This calculation adjusts the yield of a tax-exempt bond to reflect its value after accounting for taxes, helping to determine if a tax-exempt bond provides a better after-tax return compared to taxable bonds. By understanding these tax implications and calculating taxable equivalent yields, investors can make more informed decisions and optimize their after-tax returns on bond investments. Investing in bonds offers a range of options suitable for various investment goals and risk tolerances. From government and municipal bonds to corporate and green bonds, each type has its unique characteristics and risks. Understanding these aspects, along with employing strategies like laddering and diversification, can help you build a balanced portfolio. Thanks for watching. If you enjoyed this deep dive into bonds and want to learn more about smart investing, don't forget to like, subscribe, and hit the notification bell. Share your thoughts and questions in the comments below. We'd love to hear from you. For more insights and financial tips, stay tuned to our channel. Happy investing, and see you in the next video.